Hello and welcome to this video on profit, profitability and ratios. So in this video we're going to look at what are the three different types of profit and then how can we measure profitability, and to do that we're going to look at our profitability ratios. So let's start off with a quick reminder of what profit and loss is all about. Profit is the difference between revenues and costs, so total revenue minus total cost. If there's money left over, a surplus, we have a profit. If there's a shortage, then we have a loss. Now in business, there are three different measurements of profit, and we should take these definitions down in our notes. The first one is gross. Not gross because it's disgusting, gross because it's at a larger, wider scale. And the formula for gross profit is revenue minus cost of sales. Revenue minus cost of sales, where cost of sales are the direct costs of the business, i.e. buying the units for resale. So for example, if you have a t-shirt business, the revenue would be all the money they receive from selling their t-shirts. Subtract the cost of buying in the t-shirts themselves gives you the gross profit. Gross, it's kind of large. It's like saying how much have they made just from the core activity of that particular business. What is it the business really does? How much profit do they make from doing that activity? Our next type of profit is operating profit. And operating profit looks at the profit the business is generating as a whole, as an operating business. So we have revenue, we subtract the costs of sales, but we also subtract what are known as business overheads. The other costs of the business that aren't kind of direct, they're not involved necessarily with what the business directly does, but they are also costs of the business. So things like administration costs. So in our t-shirt business, we have revenue from the t-shirts, subtract the cost of making the t-shirts or buying them in, but we'd also subtract any other regular costs that the business incurs, such as maybe some administration staff, the salaries we pay them for answering the phones and dealing with emails and so on. So that's our second type of profit, operating profit. Profit comes from the business operating as a whole. Now there might be a few other costs that the business might incur, and if we subtract those as well, we have the final profit, often known as the bottom line, and that is net profit. And to get to net profit, we have to subtract any other exceptional costs. So we have the revenue, we subtract the costs of all the items, buying them in, for example our t-shirts, we subtract the costs of any other sort of regular staff and things we might need, and then we subtract other things that aren't really part of the day-to-day running of the business. So for example, if you're paying interest back on a loan, it's not really a key activity of the business, you don't need to pay that to run the business, but it is a cost the business will incur. Similarly for tax as well. So those are our three types of profit. Okay, let's have a look at a quick example. And we're going to have a look at here as an example of the single greatest football team going around. So a football club. Now, if we think about gross profit for a football club, revenue will come from the fans buying tickets and buying shirts. And then we need to subtract off the direct costs, the cost of providing that service. And in this scenario, for a football club, the direct costs would involve the players' wages. So let's imagine that the revenue for the football club is £2 million, and the direct costs, the costs involved in providing the core activity of the business are £750,000. That will give us a gross profit of 1.25 million. So the profit the business makes from running the core activity. Now, a football club might well have some other costs, perhaps some staff who work in the shop selling merchandise. There might be a number of indirect costs that the business pays out. These are not the direct costs of providing the service, but there are other costs that the business would have to pay out in order to function. So let's imagine that the indirect costs are £500,000, and therefore our operating profit would be the gross profit of 1.25 million, take off our extra indirect costs that we require to run the business to give us an operating profit 0.75 million. So this is the profit the business would make from just running its normal operations. To get to profit for the year, or net profit, we have to take off any final exceptional items. So if we imagine, for example, that this club have taken out a loan to buy their ground and they have to pay that back with interest, those interest payments would be coming out now at this stage to get us towards our profit for the year. If we imagine those exceptional items are £400,000, our final profit for the year would be the operating profit, £750,000, minus the interest payments, £400,000, to give us a final net profit of £350 million. And for the avoidance of doubt, this figure is before the business has paid tax. So any corporation tax will be paid on this amount. Now, a business will record its profit in what is known as a statement of account. So the three types of profit are set out in a standard format, and this is known sometimes as a comprehensive statement of income, or perhaps more commonly a profit and loss account, sometimes abbreviated to P&L. And this is the standard format that we would expect to see. So for example, in 2016, we can see the revenues listed first, 3,500, but this is in thousands, so that'd be £3.5 million. Then the cost of sales, and if we subtract the cost of sales, the direct costs of running the business, we would get the gross profit. Then as a business, you would present the indirect costs, for example, administrative expenses. Again, here we go, over on this side, we take those off, we get to the operating profit. So the profit the business makes from its operations. Again, the business might have some exceptional items, for example, financing costs. And if we take those off, we get the final level of profit for the year, or net profit. And if you look up any financial report from any well-known business, you will see a statement of accounts, a P&L, that is set out in this format. So let's consider these three businesses, business A, business B, and business C. And what I'd like to do is just pause the video for a second and think which of these businesses is performing the best. Well, it might be difficult. It might be difficult to say which business is performing the best because these businesses, looking at them, clearly are very different sizes. Business A is clearly the largest, £10,000 worth of revenue. Business B only has £100 of revenue, quite small, and business C is somewhere in between. So it's hard to make a comparison. What's better here, £2,800 profit or £30 profit, but that's only come from a much smaller business. So often in business, what we do to make comparisons is we use percentages. And if you were thinking of coming up with a similar idea when you pause the video to this, then you're right on the right lines. So these percentages down here are taking the profit, these different types of profit, as a percentage of revenue. So effectively saying how much of the revenue do they keep as profit. And because they're all in percentage terms, it's quite easy now to make comparisons. Even though business B is the smallest, actually it keeps the largest amount of net profit from its revenue. 30% of all its revenue it keeps as net profit. So you might say it's performing quite well at generating profit, but it allows us to make easy comparisons. And that's what profitability is all about. It's about how effective a business is at generating profit from its activities. So let's take this down in our notes. Profitability measures the financial performance of a business by comparing profits achieved to something else. For example, revenue. Comparing profits to revenue gives you an idea of how profitable the business is. And in business, we'd normally measure it by using three ratios or coming up with three sort of percentage calculations. And these are gross profit margin, operating profit margin, and profit for the year, or net profit margin. And we need to know these three. The first one, gross profit margin. This is the formula, and I'd like you to take this down, please. Gross profit margin is gross profit divided by revenue times 100. So effectively it's saying what proportion of the revenues are kept as gross profit. So if the gross profit for a business was 200,000 and the revenues were 800,000, that would be a gross profit margin of 25%. They keep 25% of their revenue as gross profit. The next one is operating profit margin. Operating profit margin is operating profit divided by revenue times by 100. And again, it is expressed as a percentage. The final one, see where it's going, net profit margin, profit from the year margin, net profit divided by revenues times 100. Again, net profit margin is expressed as a percentage. Now these margins are very useful because they help us to compare businesses. So for example, in this table here we have company A, B and C, we have sales, profit, and we also have operating profit margin. Now company A makes a higher profit than company B, even though its sales are lower, and that is because they have a higher operating profit margin. This business, company A, keeps 33% of their revenue, of their sales, as operating profit, whereas company B only keeps 10%. So even though company B is bigger and has more revenue, it doesn't perform as well in terms of profitability. It's not as successful at converting its revenue into profit. Company C makes the highest operating profit, 125,000, but it does not have the highest margin. It has the second highest margin. It only keeps 25% of its revenue as operating profit. So whilst it's the biggest company, here we might say that company A is the most profitable, it's the best at keeping or generating a profit from its activities. So it's very useful for us to make comparisons between different businesses. So in this video we've looked at the three different types of profit and then explored the three profitability ratios. That's it. Thanks very much for listening.